There is a financial strategy out there that is being used by the biggest corporations in the world. It's secure, it's stable, it's tax efficient, but the average person uses it in a completely different way and is missing out on the biggest opportunity out there and access to capital with infinite control. And that is exactly why I'm so excited to have Sarbalo Gill join us to break this strategy down so you can access capital and infinitely control it, because control is the nature of the game in real estate. Whether you're building a small portfolio, a big portfolio, control is what really matters. So let's bring on Sarbalo on here. Welcome. Really excited to have you join us today.
Thank you, Seth. I'm excited to be here.
Yeah, so super interested. So I teased the strategy that we have that some of the biggest companies in the world are using, but I think it's really misused by the average Canadian or the average American. So can you break down for us exactly what we're talking about and why this actually matters for real estate investors?
Absolutely. So what we're going to discuss today, Seth, is the process of becoming a banker, the infinite banking concept. And Seth, you mentioned a key word that is such a crucial word when it comes to building wealth, which is the word control. Now, I'll go back in time a bit. I'll go back to early 1980s when inflation had skyrocketed.
Oh, it's kind of like today.
Yeah, exactly like today. So we're kind of experiencing something similar to that. And back in 1980s, when the inflation had skyrocketed, the prime interest for a prime customer at a bank when they want to borrow money was at 21%. Now, if someone at that time owed money to the bank and the prime went up to 21%, you can imagine the sleepless nights that they would have had at that time. And we are experiencing that today where, beginning of 2022 and all the way to where we are today, starting 2023, the interest rates have skyrocketed, the inflation has gone up. And what I'm getting as a feedback from prospect clients who are in real estate is what they're saying is we don't have much control anymore. Our cash flow has gone down. We're not cash positive. Is there a better way for us to go about financing the things that we want to finance, especially real estate and multifamily, which brings back the control so that we're not in that position anymore? What else is out there in the marketplace? And that's what we teach Canadians and soon to be Americans, is the concept called becoming a banker, the infinite banking concept. The person who created and founded this process, his name is R. Nelson Nash. Back in 1980s, he was a very successful real estate investor. He made a lot of money in real estate. But when he had $500,000 in loan balances to banks at that time, and prime went to 21%, you can imagine just the interest payments per year. And this is back in 1980s. $500,000 in 1980s was a lot of money compared to today when you add inflation and all that. So Nelson at that time, he had been storing capital in a very unique instrument, which some people may be familiar with, but most people don't know about it. And that instrument is called a participating dividend-paying whole life insurance contract. Now, most people know that they can actually put money into a participating dividend-paying whole life insurance policy, and they can borrow against it at the interest rate what the insurance companies charge, and then they have actually access to capital on demand, meaning they don't have to qualify for the loan to borrow money from the insurance company. So Nelson had a participating dividend-paying whole life policy, which his brother had sold him when he was back in 1959. That's when he actually bought a first policy. And the reason why he bought that policy was for the purpose of meeting his need for insurance for the family, for that benefit. And Nelson had been putting money into that policy. And when 1980s happened and interest rates skyrocketed, and with all the prayers that he had to do because there were sleepless nights, the solution was right in front of him, which was a policy loan. And it struck him at that time saying, hey, I can borrow money from the insurance company at 8%, and I don't have to qualify for the policy loan. It's on-demand capital, and I can borrow money from insurance company at 8% and stop paying the bank at 21% and regain that control back into my own policy. Because when a policy owner borrows money from the insurance company, you don't have to qualify to access money as a loan. Insurance companies cannot dictate the loan repayment terms to the policy owner. And all that is total and absolute control. So borrowing money at a lower rate and paying the banks at a higher rate. And Nelson was, well, this is great. So it took him about 10 to 15 years to take money from the insurance company and pay off the bank completely. And fast forward to that point, after that, Nelson and his family never saw another commercial bank for the purpose of financing anymore. They created their own family banking system, which is the participating dividend paying whole life policy. When Nelson passed away, and this goes back several years, Nelson at that time had created about 50 policies in his family, and they used those 50 policies all the time to finance whatever they needed for the families, whether it's for real estate investment, whether it's for buying cars, private lending, anything that the family wanted to use the money for.
Yeah, and I think the exciting thing with this is, when you're borrowing money from your policy, you're actually still earning, whatever rate you're earning in your policy. Like, that doesn't stop. So even though your money's, you can take that money, put it to good work in some sort of investment, you're still earning over here as well as your policy continues to build up its value. So I guess, like, right now, you mentioned interest rates, right? Interest rates are a big concern right now. I just went to the grocery store last night, and every day I'm shocked at how much prices are going up. How is using insurance participating policies like this in terms of the infinite banking system, how is this being impacted today by inflation, or is it being impacted at all?
See, these policies have very set contractual guarantees in place. And the number one contractual guarantee that insurance company have to fulfill is the death benefit. God forbid something happens to the life insured, they have to pay death benefit. The number two contractual guarantee is accumulation and growth of something called cash value. So when policy owners put premium into these policies, the premium buys one thing and one thing alone, and that is death benefit. And based on insurance companies' contractual guarantee, which is cash value accumulation, the cash value has to accumulate and grow every day to match the death benefit by age 100. So if you use an example of someone who's 45 and they're just starting a policy from age 45 all the way till age 100, and they don't have to live till age 100 for that contractual guarantee to be met. The teaching point is, as we wake up, we are one day closer to age 100. Hence, our cash values keep increasing because it has to match the death benefit by age 100. So the whole teaching point regarding is inflation goes up, inflation goes down, interest rates go up, interest rates go down, market goes up, market goes down. That happens all the time. But one thing that never changes is the process called banking. Someone has to control that process in our lives, and that someone should be us. So if you have ready access to capital and you're able to borrow against that capital, it doesn't matter whether it's inflation or no inflation, to capitalize on opportunities that will come up because of the environment that we're in. Because Seth, you can confirm for me, do you think we're going to have a lot of opportunities to buy when it comes to real estate in the next few months or a couple of years?
But we are taking very active steps to fully capitalize upon the opportunities that the next 2 years or 3 years are going to bring. 100%,
100%, right? So yeah, inflation is going up, but it may create access to opportunities. Now, to someone to buy those opportunities or capitalize into those opportunities, they need access to capital. Now, if you can access capital the way I just described, which is you can borrow against your ever-growing pool of capital, you're still able to grow your capital and still have access and still capitalize and buying into multifamily real estate investment. You still are able to accomplish the objective of buying the investment, but none of your capital ever stopped working for you. So you're growing capital as you're buying investments. Like, where else can you? See, compounding is the best thing ever, but dual compounding, that's fantastic.
Yeah, like compound interest. Who is it? It's like the greatest. It's the greatest thing in the world. Or there's a quote about compound interest.
Compounding is the eighth wonder of the world.
Yeah, there you go. That's what it is. Now, let's talk about like a passive real estate investor, right? Because like a lot of people, and that's what draws a lot of people to real estate, that passive income, that passive check that comes in. So whether you're sleeping, you're awake, you're on the beach, you're working hard, whatever happens, you're going to have that steady stream of checks coming in. So the passive side's very attractive and very important. How does the infinite banking concept pair with somebody who wants to passively invest in real estate investments?
So think about. So I'll use an example, and I'm going to use my own example in this particular for this particular question set. So I had an opportunity to collaborate with an investor who's buying some multifamily residential properties presently, and this particular investor needed access to capital. Like all investors need access to capital. So he reached out to me and said, "Hey, Serbo, this is the property that we're going to be investing in. Here's the underwriting. Here's the deal in terms of how much we need as in terms of capital to buy. And then, we're going to do some increased NOIs in the property. We're going to change the underwriting. We're going to increase the valuation, and then we're going to refinance the property from the bank and get all the cash back. But over that transaction, Serbo, I need access to capital. I don't have capital. I have the opportunity, but I don't have the capital." So it created a collaboration opportunity for me with him. And the access to capital that he wanted was about close to $300,000. Now, I have been practicing the concept of becoming a banker since 2016. So I'm almost 7 years in, and I put a good chunk of my own capital in these policies because capitalization is key in building a banking business. Banks need money to operate. The more money you put into the banking system, the more money they'll have. No different than that. The more money we put into our banking system, the more money we're going to compound and grow and have access to capital when opportunities come. So he needed access to capital. I had access to capital, and I had access to capital on demand without interrupting my own growth of money. So what I did was I initiated a policy loan from the insurance company. And when I initiated a policy loan, the only question they asked me was, "Sherblo, okay, we're going to give you $300,000 because your policy can be used as collateral for this loan. You have more than enough money in the policy to be collateralized. And just let us know if you want this money to be sent to you via check or if you want this money to be sent to you electronically deposited." That's how I access a loan. Now, Seth, is that a little different than how most people would access money or loan from the bank versus how I access money as a loan?
It's quite different because right now, obviously, what happens whenever the economy contracts and where we're heading, like right now, we're in recession. No matter what somebody tells you on the news, lending tightens up. Criteria becomes a lot more stringent, and then also you have to give your arm, leg, and probably your firstborn child to get a loan of any sizable amount. So the fact that you can just call up your provider and say, "Hey, listen, I need this amount," like, send me the check. That's a very different process.
It's a very different process. On-demand capital, right? So I borrowed money. Now, Seth, when we borrow money, like in this case, I borrowed money as a loan. That money is insurance company's money. It's not my money because I used my money, which is cash value, as collateral. My cash value is growing every day because they have to fulfill their contractual guarantee. So I'm using insurance company's money. So if I use someone else's money, in this case, do you think they're going to charge interest to me to use their money?
Oh, yeah, that's how the banks make their money.
That's how the banks make money. And same thing with the insurance company. The insurance company is a business. The business is to be profitable. So they charge me interest. The interest was simple interest, 6.2%. And then most people will look at that and they're like, and they'll just get their head wrapped around, "Oh, it's 6.2%. That's well, based on where the interest rates are today, that doesn't seem high anymore. But if you go back a year, people may think, hey, it's a higher rate." Well, here's another teaching point. The process of becoming a banker has nothing to do with rate, and here's what I mean. So when I access that loan, $300,000, the interest from this particular insurance company that holds my policy is 6.2%. It's annualized interest, but the interest gets charged on daily basis. So 300,000 multiplied by 6.2% divided by 365, the interest per day is $50.95. And here's the best part. I decide when to pay the loan back to the insurance company. I decide when to pay back principal, when to pay back interest, all principal and interest. Insurance company cannot dictate that to me. I control that. And here's another best part about this loan. It's a policy loan. It's private between me and the insurance company. That loan is not going to show up on my credit report. It doesn't show up on Equifax. It doesn't show up on TransUnion. Are keeping things private today really important?
Oh yeah, especially if you're somebody who is still investing on your own personal name, and you're going to qualify for financing, maybe on residential loans. Like let's say you're going to buy a house, the bank's going to know every single car loan you have, every rental property you have, all that kind of stuff, and that's going to hurt your ability to qualify for that debt. So whenever it's very similar to, let's say, private lending, that sometimes you can craft in a way where it's not showing up to the banks, and that's going to help you be able to qualify for some more stuff. So 100%, like the more you can keep it off your credit report, the better.
Exactly.
Yeah.
So I got access to capital. It's $50 per day as interest to me on this loan. An insurance company says, well, we have your cash as collateral, Cerblo, so we are secured. And by the way, Cerblo, you don't have a lease on life. We know that. Someday you're going to die. You're going to graduate. You're going to leave this planet. And if you have a principal and interest outstanding on your loan, we'll just deduct it from the death benefit, which we promised to pay your family anyways. My death benefit in this system of policies is over $10 million. So if God forbid something happens to me, my family will be fine because insurance company will take 10 million minus 300,000, and that's what my family gets. So if I die prematurely, do you think my family is fine, Seth?
It's well, they might be a little bit sad.
They will be sad, yes. And I keep telling my wife, hey, please pretend to be sad for at least 10 minutes on my funeral because you're going to get all that money. So that's just jokes aside. So going back to this example, so the interest is $50 per day. Now, I have about 18 policies. So when I requested this loan, it came from 18 policies. Now, my daily growth on these policies is over $200 a day. Now, how do I know this number? Because I can look at my policy growth every day. I capture my number today. Today is Jan 11th. I'll wake up tomorrow. Tomorrow is Jan 12th. My daily growth in the policy is almost $220 a day. So Seth, am I okay paying $50 to the insurance company and still make $220 per day as daily growth of my own capital? Is that a good exchange on the transaction?
Yeah, for sure. And I think one of the exciting things is this is really an arbitrage play.
Yes.
An arbitrage play that's not going to have those like ups and like you don't have to worry about the volatility on it. It's a very stable, and it's so consistent. So you can make long-term projections because like you were saying, whatever happens, you're waking up, you're 200 whatever dollars ahead that day, no matter what happens, and you don't really find that stability in the public markets or anywhere else.
Absolutely. So I took that money and I gave it to the investor. Now I charge this investor 15% per year on that loan. That's how I structured it. So Seth, how am I doing when it comes to passive income on multifamily now?
You're doing pretty good.
Pretty good.
You're doing pretty good.
And can I also get to write off the interest that insurance company is charging because I borrowed money to make profit on that loan?
Absolutely.
So I grow my money tax-free because my cash values in the policy keep increasing tax-free. There's never tax in that. So my capital grows tax-free. I'm able to access capital, earn 15%, and I get tax deductions on the interest that will pay to the insurance company. Like how many more times I should not be doing this?
Yeah, like that. This is like you do it once, and I think you said you have like 18 different policies. So I'm actually like, can we dive into that? Because I'm curious. What is the advantage of having 18 separate policies versus like having one or two that are just loaded up? Can you walk us through the thought process there?
That's a great question. See, I got started going back to 2016. That's when I started, and we start with what we want to get started. And our clients get started with what they are comfortable getting started when it comes to premium into these policies. And we encourage everybody to think about this as your banking system, as your financing system that you're going to create. So don't think of premium as a payment. Think of this as a deposit. Because isn't it true? And viewers watching this real time, I'm speaking to the viewer now, isn't it true that all your money today is flowing to the books of someone else's bank and you're okay with it?
Yeah, no, that definitely happens, right? That's why banks are setting record level profits right now because that's the business they're in. Like that's their revenue source.
So they need deposits to make profit, and their deposits are our money. So all our income flows through the books of someone else's bank. So if we want to take over that business in our life, so-called banking, Seth, you mentioned banks make record-breaking profits, and they've been doing this, I don't know, since pants.
So, maybe before that.
Maybe before that. So if that business makes sense, should we not rethink our thinking and say, hey, how can we get into that business at you and my level? And the way we can do that is by implementing this process. And here's the best part. Banks need a chartered license to become a bank. You don't need a chartered license to start practicing banking. You just need some education and guidance and coaching to get started. It's the best business to be in.
Yeah, 100%. So like walk us through. So you set up your first policy. Now, obviously, not every policy is going to be the same, right? Like some policies probably don't have, like, can you walk us through, like, because I'm assuming that what would it be, like 80% of policies aren't a good fit, so you have to be very specialized and know exactly like what you're doing to get this started?
Yeah, so that's a good question. So we get this question all the time. So you have to have the right policy in place to implement the process of becoming a banker. It has to be the right insurance company, and you have to be coached on it, because this is something brand new, and you're going to need coaching on it till the end of time. So you have to get coaching from someone who's best at this process when it comes to implementation. So there's certain factors that have to be considered. But also, said to answer one of the questions that you had, why do we have 18 policies? Because once we start a policy, it doesn't matter what premium we start at. Usually that premium is maxed in that policy. We can't put anything more than that. So if you want to do more banking policies, if you want to flow more money into policies as premium, we'll have to do more policies. And the way we expand the program or system of policies in a family or in a business is also insuring multiple people, because nobody has a lease on life. You want to make sure that the overall risk to the family or the business is taken care of. God forbid something happens to that particular person. So in my family, for example, I have policies on myself, I have policies on my wife, I have policies on my daughter, but I own those policies. So when I request policy loans, I can request loans from all policies at one time. They're all family banking systems.
Yeah, and I think the interesting thing here is, like, you're speaking in terms of a family system, not an individual. And I know, having read Nash's book, it's all about creating like a whole family net of interconnected financial control. So can you kind of walk us through, what that really means? Because, a lot of people just think about themselves. So, for instance, when I first got my, I got a term policy a long time ago because I was young, it was cheap. I got term. I wasn't thinking of an interconnected family. I was just thinking of myself. So walk us through that mindset shift and the benefits of it.
Absolutely. So biggest benefit is, see, the system has to continue over generations. Nelson has a few golden rules which are set so that we can be a good banker. The number one golden rule is think long range. And long range doesn't mean 10, 15, 20 years from today. Long range means think 3 generations past yours. So if I have all the policies on me and I haven't done the due diligence of insuring policies for my daughter and my wife, and I pass away and it's all policies on me, then one death benefit will be paid, and then the system is done. Whereas if I have policies on my wife and daughter today, something happens to me, they know for sure they have their policies in place that they can use going forward for the things that they need, thinking long range based on our family goals over the next 3 generations. When they get a windfall upon my death, they can use that windfall to crank up more policies. But as they already have policies in place, which are well compounded, well capitalized, they can continue and practice the process of becoming a banker for themselves going forward.
Yeah. Now, is there a limit? And because, looking at banks, like lots of banks will limit their risk exposure. So they'll limit how many mortgages or loans you can have at any one institution. Is there a limit in terms of like how many policies one person can have?
That's a good question. So there's no limit on how many policies can one person have, but there's a limit on how much death benefit insurance company will issue on one individual. It doesn't matter how many policies it takes for you or the person to hit that limit, but once you hit that limit, then you can get more policies on yourself. Then you have to look at other bodies to be insured.
Yeah, exactly. And we were talking about the tax-free aspect of this, and this is why people love real estate investing. Like
Yes.
capital gains is far more efficient and attractive than earned income. Now, if we can grow our money in a way that we can access it, we can use it to invest in real estate and do other things, but it's growing in a tax-free way. Like I think that's absolutely amazing. So why does the government not tax us in insurance policies, and walk us through, why it's set up the way it is?
That's a good question. So yeah, tax rate is important. No tax is even better. So these policies are literally tax exempt. So if you think about the nature of the policy, see, what we are talking today is about the living benefits, which is the implementation of the process of becoming a banker using these policies. But the underlying aspect of these policies is life insurance, is death benefit. Now, do you think our government has money today?
Well, it depends who you talk to. But I would say the government is very good at taking our money. Yes.
But they are literally broke.
Well, yeah, that's why they have to print more money.
Yeah. So the reason why this is not taxed at all, and it's the biggest tax exempt in the tax code, is because the government wants us to take care of our families when we die. That's why it's tax free, because the government doesn't have enough money to take care of our families when we're gone.
Yeah, for sure. So, and like you said, the money's going to get paid out no matter what. And if we have an owing balance on the money we've retrieved, the insurance company is just going to, change the payout to accommodate, the money that's already out. So I think, financial institutions, when we're looking at financing property, especially with recourse debt, they're always looking for ways to make themselves whole. They don't have to tap into your other assets. You don't have to collateralize your home. You don't have to collateralize your automobile. Because the insurance policy is acting as that collateral, and that's getting paid no matter what happens. So it's a very intriguing way of borrowing money and using money that's very unlike anything else that exists right now in what I guess you could call the typical financial institution landscape. Does that make sense?
It does, and that's why investors, when they come to us, they're like, man, we can't get enough of it. I want to just get started, Cerebro, and I want to just insure myself, my daughter, my son, my wife, my business partner, my real estate joint venture partner. They just can't get enough of it because they want to just scale their real estate portfolio. And the quickest way to do that is when you have access to capital. And if you can access capital with control and still keep everything private and insure that loan, because the insurance company in this case itself is collateralizing and guaranteeing the collateral on the loan, it creates win-win situations. I'll give you another quick example of how one of my clients, who's a real estate investor, they use the system to scale real estate portfolio very quickly. So I'm going to use just one little example in this. So this particular person wanted to buy a condo. It was a distressed property in Edmonton, Alberta, and the value was $200,000. Yes, in Edmonton, you can buy a 2-bedroom, 2-bathroom condo for $200,000. Now, it was distressed, so he actually got the property for $180,000, which would include a little bit of renovation. Now, he had been putting money into policies for several years. So when this opportunity came up for him, he just initiated a policy loan from the insurance company, again, without interrupting his capital, and he purchased the condo. Now, the condo is technically owned free and clear by the investor because the loan didn't show up on his TransUnion or Equifax. There's no lien on the property. The lien for the loan is his future dead self. So after doing some renovation, he could actually increase the fair market value of the property and sell it for $220,000. Now, let's just say he didn't had a perfect buyer and he couldn't sell the property for $220,000. Maybe he would. Is he in distressed position that he has to pay the loan back, or is he in control position, saying, "Hey, if the property doesn't sell, I still have control. I'll pay back the loan when I want to, but nobody's going to come knocking on my door and demand the capital back."
Yeah, no, he's in complete control, and as long as he's cash flowing with that property, he's in a great spot. Now, let's take this example further. So he was able to use the money that was sitting there to act fast on a distressed property, And over the next couple of years, there's going to be situations where an owner's distressed, and you'll have to act very quickly to take that property off their hands. So that's going to present a lot of opportunity. I guess what you're in that example, what he could have done is acquire the property. He technically owns it free and clear. He then could have gone to a financial institution if he really wanted to, put a mortgage on that, and then use that policy to go find another one, and then rinse and repeat the entire process.
That's exactly you just got into my mind, and you got the exact scenario. That's fantastic.
Sorry, I kind of rained on your parade there.
No, it's all good. So that's exactly what his options were, because as an investor, we have to work with risk, and the risk is, okay, if I don't sell the property, what's my exit plan? For him, he wasn't stressed about the exit plan because he was in control. He could have rented the condo, and the tenant would have paid his bank back. So this is what the banks do. Someone else pays the loan back. So in this case, his tenant would have paid the loan back. And let's say he had to rent it out, but the condo is owned free and clear. He can literally take that condo to the bank and say, hey, Mr. Bank, I understand you guys love collateralizing properties. Can you register a line of credit on the property for me? Or can you refinance the property and give me 80% back? And he could have now taken bank's money and bought another property, which produces another cash flow. So by initiating one policy loan, he would have basically ended up buying two properties, two assets, two cash flows, while all his money is in the policy growing and compounding uninterrupted, and will also enjoy all the deductions that'll come as part of being an investor. So how else can we do this?
Yeah, and once he refinances the property, if he improved the value somewhat, you can take that money, and then it just snowballs after that. Because once you improve the property, you're basically using the bank's money at that point. You're using your policy's money, your own bank's money, and then also the regular financial institution's money.
Bingo.
Now one of the things I'm wondering is, I think one of the things out there in terms of insurance policies is, with universal life, whole life policies, everybody knows like the commissions being paid are really big. So if somebody's setting up their own, infinite banking concept, their own family bank, are they paying through the nose for their first 5 years and they can't access their money? Like how does it work in terms of how much money do you actually need to get started with setting up your own infinite bank?
That's a good question, Seth. So what someone needs to do is really, first thing first is, if someone is looking at, okay, this sounds really good, this sounds really amazing, okay, how do I get started? Well, the first thing is, get a copy of this book and go through it and read it and educate yourself. And then meet with an authorized infinite banking practitioner who can actually walk you through how the policy is going to be designed based on your goals, your objectives, what you want to get accomplished on a short-term basis, financially, or long-term basis. Now, we have clients, Seth, who put a couple of $100 a month into policy. Those are usually juvenile policies that a parent or a grandparent wants to do on their child or grandchild. And we have clients who put 6 figures a year into policies. So if someone is between a couple of $100 per month to 6 figures, this process is going to work, because it's ultimately about them becoming their own banker based on their lifestyle today, based on their goals. Everybody is different. There's no set criteria on what's the magic number to put into policy to get started. When someone gets started, doesn't matter what premium amount they put in to get started, they're going to feel real good about it because it's going to work immediately. We don't have clients waiting 5 years to get access to capital. They take capital back within 30 days of getting started. It works immediately.
Yeah, I have some friends who've dumped quite a bit of money into their policies, and we're talking millions of dollars in these policies, and they're using it. Now, one of the questions I certainly have is, this works great for individuals, but for people who have various companies out there. Yeah. How does this work with corporations and that type of structuring? Because in the teaser right at the start of today's video, I mentioned that some of the biggest companies in the world are using this too. So walk us through how it works on the corporate side.
Absolutely. So corporations are no different than individuals. It's just a separate entity altogether. So we have clients who have corporate-owned policies in their holding company, for example. And the purpose behind creating that policy is to build more wealth corporately. A lot of real estate investors are building wealth in their holding companies going forward. See, holding companies are just like individuals. It's just a separate entity. They have bank accounts. They have money that they're setting aside for the purpose of growing and scaling wealth in the corporation. Well, that money has to sit somewhere. Let's just agree that money needs a warehouse. Money needs to sit in a pocket, in a wallet, underneath a mattress, behind a toilet tank. It needs a warehouse. So what better place to warehouse money other than the policy? If you can put money into an entity where the value of that capital going forward will never be less than what it is today, like how much of your money you don't want in an entity like this? And once the money is sitting here and is growing, from here, you can actually borrow and finance the things that we want to finance, and it can be corporately. So corporation has a beneficial interest in the shareholders of the business. A corporation has a beneficial interest in the key person in the business. So corporation can own a policy on those individuals. And then when the policy loans are initiated, money comes to the corporation, and corporation can use that money and go buy real estate, go do private lending, go do syndication, whatever the objective is for the shareholder to build corporate wealth. Now, policy cash value growth, policy is not a passive income tool. So there's no passive income tax on the daily cash value growth in the policy. Passive income is taxed at the highest in the corporation today. It's crazy.
It is. It absolutely is. And like, I'm just thinking some of my friends, like, they've done very well for themselves, and they can't get rid of their money fast enough. So they're actually using policies like this to they are funding policies left, right, and center just to get their money working, and now is fully accessible to them. And then they can go out whenever they come across a venture that they want to do, a business they want to acquire, real estate, whatever it is. It's ready to rock. Now, yeah. I guess my question is, yeah, this sounds really good, but like, there's got to be people out there where this isn't really a good fit for them, right?
Well, that's a good question. So it's not a good. I don't say it's not a good fit. There's certain things that have to be done to make sure that this is a good fit. First thing is education. Nothing beats education, right? So again, I'm sounding like a broken record. But, get a copy of this book. It's 92 pages. And it's written not for someone like me. It's written for general public, for everyday person. And it'll take someone maybe 4 hours to read this book if they're a slow reader like me. And then after this, they can literally make a decision on, okay, this sounds really good. How does it apply for me? And then they can take the next steps from there onwards. But in terms of, someone who's not a right fit, I haven't met someone who this process doesn't work for. I haven't met anybody like that. I've been doing this for 7 years, but I don't work with everybody. And the reason why is because they have to catch it. It's not something I can teach. They have to catch it. And once they catch it, then they know exactly what to do. It's not that they're not ready to go. It's just that they may not be ready to go today. But as they consume more content, the resources that we're going to give them, they'll catch it. They have to rethink their thinking before they get into this. So.
Yeah, for sure. So, we talked about some people when they first start, they're putting $50, $100, couple $100 in their policies. Other people are dumping 6 figures right off the bat into the policies. Can you take us ahead maybe 30, 40, 50 years from when somebody first starts using this strategy? What does it look like? Because, we talked about real estate examples, but can you walk us through all the different facets of life where this infinite banking concept can really help the family bank?
Yeah. So think about all the money that the family needs for the time to come. Think about all the transactions they have to make. They need transactions for, maybe if they're a business owner, they may need transactions to grow business. They may need transactions for building real estate portfolio. They need transactions for buying cars. They may need transactions for buying or taking family on vacation, sending kids to education. They're going to need money for retirement. So think about all the things that they need to buy over a lifetime. Someone has to control the most important function over these transactions, and that's banking. And if that function is not controlled by that individual or by that corporation, then that individual and corporation will be doing all the work to earn an income, but everybody else is going to get all their money. And if everybody else gets their own money, does that put them in a stronger financial position or a weaker financial position?
No, we want to keep the control.
We want to keep the control, and
Yeah.
we want to keep the money flowing back to us, not away from us. And the best way to do that is to not change your cash flow, is not to change your goals, is just to change the process to get to those goals. And you just have to add one extra step process to what you already are doing, and it's going to radically enhance the outcome of that objective. And that extra step is to be the banker over the transaction.
Yeah, and I'm thinking, ahead. Even with my situation, right? My son is 6 now, so he's going to have to go to school if he chooses to go to school. He'll, we have vehicles to look after. We've got, down payments on his first house to look at. We've got all sorts of things coming up, and all of those can be handled and funded through our infinite banking system, right? We don't have to go outside of that to get that done.
Exactly. And again, thinking long range, that's one golden rule. And the second golden rule that Nelson has is don't be afraid to capitalize. I actually see, knowing what I know, and this was just me getting started back in 2016. So, my first policy set wasn't what I'm doing today when it comes to what I'm able to do today. My first policy was $5,000 per year in premium. That's where I got started. And looking back, that policy has done amazing. That policy is now used for my family vacations, for my child's daycare expenses, for the things that my kid is going to need. I've allocated that policy for that particular objective. But I could have started with a higher premium at that time. I just chose not to do that. And it's not a regret to me. It's just that it's a coaching opportunity for me to coach everybody about the mistakes that I made. Don't be afraid to capitalize, because I lost time of compounding over the last 7 years now because nobody taught me.
Yeah, no, for sure. And is there a time, because obviously, insurance, the older you get, your risk of death goes up, the risk of illness goes up. Is there a sweet spot in terms of when somebody should start using the infinite banking concept?
So we have clients who are not insurable, but it's not preventing them from starting the process, because what they do is they become a policy owner on someone on which they have a beneficial interest in. So a grandparent taking policy on a grandchild, a parent taking policy on their child, husband taking policy on wife taking policy on husband, spouses insuring each other. So if you're not insurable, that's not going to change anything. We just have to find the right person that you can insure. So for example, I'm going to use this example. So I have policies on my daughter. My daughter was 30 days of age when I started her first policy. We were getting child tax benefit. We just took that money, masked it from our income, and started her first policy. So God forbid something happens to me, that ownership goes to my wife, and then my wife becomes the owner. And at sometime in future, we'll transfer that ownership to my daughter. So I'm setting something up for her today that she's not able to do, but I'm taking advantage of using the policy today for the purpose of what the family needs money for. So if you're not insurable, you can take a policy to someone else who's insurable, still enjoy all the benefits. You'll end up creating an asset for the next generation. And then when that asset ownership gets transferred from you to the next generation, it doesn't trigger any tax on the transfer of the ownership.
Yeah, and that's, that's a totally different subject for another day in terms of, moving wealth and shifting wealth from one generation to the next. And insurance policies are an excellent way to do that, especially if you're Canadian. Because in the US, you've got a couple different, especially in the real estate space. So that's super exciting. So I guess just to wrap everything up, if you were to go back in time to when you first got your first policy, knowing what you know now, what would you have changed about how you went about getting into infinite banking?
That's an awesome question, Seth. What I would have done is I would have got a mentor, a coach, which I had at that time, and I still have that mentor. But if I wanted to go back and really enhance that potential, I would just go to my mentor and say, coach me, put me to work, tell me everything, how I want to do this the right way. And that's how I'll get started. But I would follow the coaching and guidance from my mentor 100%, and I won't deviate from that.
Yeah.
The reason why I deviated was because I made a decision of not to really capitalize. My mentor had nothing to do with it. He told me to capitalize. I chose not to. So,
yeah, exactly. And, Can you give us, just before we wrap up, can you give us some examples of maybe some of your top clients and the freedom and the results they've been able to achieve for themselves and their families?
Absolutely, Seth. How about 100% debt free in a matter of 3 years? And the debt load was over $300,000.
That's
So
pretty cool.
that's pretty cool. So they're not run by the banks anymore. They don't need the banks anymore in their life because they control 100% of their banking function as it relates to their needs. And it hasn't taken away any of the options for them.
Mhm.
How about access to capital for opportunities that'll come up? And real estate investor clients that we have, they do that all the time. And they are grateful. Now, what has transpired just over the last 18 months? How do you think this? What's happened on the stock market and Bay Street and Wall Street and mutual funds and all that?
Yeah, well, we've had a bit of a roller coaster.
We've had a roller coaster. Guess how many calls that we get from the client saying, "Hey, Serblo and team, I'm really ticked off that my cash values keep increasing every single day, and it really bothers me."
You might get that one oddball, but probably not very many.
So in fact, when things went the other way, when the economy over the last few months, we had clients reaching out to us saying, "We are so grateful that we met you. We just don't appreciate the fact that we didn't meet you guys 10 years ago." I said, "Well, the best time to plant a tree was 10 years ago. When is the second best time?"
Yeah, today. Same thing
Today.
with real estate, right? When was the
Exactly.
best time to buy real estate? Well, it was 10 years ago.
So yeah, so our clients can sleep easy knowing that the only investment they have to make is wake up. And the moment they wake up, they have more cash. And then they have more cash, they have more opportunities that they can use the cash for. And it has
Yeah.
nothing to do with what happens on Bay Street, Wall Street. Stock market can go jump off the Mount Everest and commit a suicide. Cash values will not stop growing.
Yeah. No, this is a really cool strategy and concept. So, Sarbalo, if somebody's looking to kind of learn how they get started, maybe maybe it's your first time hearing about this concept, where can people find you?
Well said. They can reach our head office. The phone number is 780-809-4599. And when you call, you'll be greeted by amazing folks on the team. You can check our website. It's www.ascendantfinancial.ca. To take a deeper dive into more content, you can also hop onto our on-demand webinar, which is learnwithj.com. So that's learnwithj.com. And that's how you can consume more content or get in touch with us.
No, that's awesome. So I know we have a couple questions that came in, or there were a bunch of questions. So Katie, can you tee us up here with some Q&A? So Neil's wondering, how long does it take to build up capital? Now, I think this would depend upon a couple factors, but can you just walk us through a scenario?
The time it takes to build capital is all relevant to how much capital you want to put in and what your goals are. You can start using the capital right away, immediately. Like on 30-day of starting a policy, you already have access to capital that you can put to work. Now, one thing that I would, just want to put that seed in everybody's mind's eye is life a 100-meter sprint or is life a marathon?
Life is a marathon, even though I try and make it like a sprint.
Yes. So life is long. And how long does someone need access to capital? It's for the remaining of your life. So think about that. In the era of instant coffee, instant tea, instant everything, there may not be instant gratification. There is delayed gratification for sure. No different than real estate.
Yeah, for sure. Sean's wondering what insurance company is used. Can you give us details with that?
Well, that all based on someone's goals and objectives. Now, I'm not going to do a commercial for a real estate company, but I'll give you some history regarding some of the companies that we work with, but I'm not going to say which one is the best. It's something which is unique to someone's goals. So Seth, have you heard of insurance company called Canada Life, like the country Canada, Canada Life?
Oh, I think they own a couple buildings.
Yeah, they do. They got a lot of money. So
Yeah.
Canada Life started as an insurance company in the year 1847. That's way more than you, me combined in terms of age, right?
Pre-Confederation.
Yes. So that's when they sold the first participating dividend-paying whole life policy in Canada. Now they've been growing cash values every day since then. Now these policies also pay dividends. Now, Seth, can you guess since when is Canada Life has actually paid it? Oh, you know what? Let me ask this question differently. Can you just give me how many number of years has Canada Life actually failed to produce a profit and pay dividends to policy owners since 1847?
I would guess 0.
It is 0. They have paid dividends since 1848, every single year without a miss. Now think about that. Can a business ever pay dividend if the business is not profitable?
No.
No. So they have been profitable for the last 170 plus years. So they must be doing something right. Now that's just one of the companies.
They own lots of apartment buildings.
They do. See, insurance companies no different than some investors. They put their money. Sorry, I should say insurance companies do not invest money. They lend money with security against collateral to create a consistent flow of money coming back to them, because they want to control that whole experience. They want to control the whole transaction. They cannot risk a loss of money, because what insurance companies doing is the risk that insurance companies managing is premature death. They cannot go borrow money from the bank to pay that benefit. So they have to be very careful with where they invest money, and they don't invest money in Facebooks and Twitters and Teslas. They invest money where there is a high probability of getting a return of capital first before anything else.
Yeah, 100%. Neil, we spoke about this a little bit, but can you touch on it again? Can you apply through a corporation?
100%. Corporation has need for financing. Corporate has capital. Capital has to sit somewhere. So 100% a corporation can own a policy on the shareholder of the business. And that policy can be used to implement the process called becoming a banker.
Awesome. All right. Well, Sarbil, just want to say thanks so much for taking the time today and sharing this really cool strategy with us that a lot of people don't know about. And they're leaving so much control on the table, as well as access to capital, which is like rule number 1 with real estate. So I really appreciate your time. Thank you so much. And I can't wait to see you soon.
Thank you, Seth, for having me. This has been great.